I'm Vicky.
I'm Ethan.
I'm Yvonne. We're doing finance briefing for Qantas Airways today, and Ethan will start our presentation first.
Firstly, Qantas works on a couple of initiatives for its domestic market in Australia. Qantas and Jetstar had combined around 90% of the profit pool with over 60% of the market share. The initiatives included strengthening their network, improving customer satisfaction, and focus on cost control. Moreover, the total profit pool for Australian aviation market also dropped, thus putting Qantas as a top leader in the Australian aviation market. Secondly, Qantas loyalty grows from a frequent flyer program into a diversified airline loyalty business. New partners are introduced like Airbnb, and new products are released like Qantas Cash. At the same time, Qantas Loyalty helped to strengthen their social status as a customer-focused airway. Moreover, Qantas invests more in new digital technology to better communicate with their customers with upgraded apps, personalized communications, and tailored online journey. Thirdly, Qantas diverted more than 50% of its international capacity because of strong demand, which is the world's fastest growing aviation market. Financial performance, the Qantas Group reported an underlying profit before tax of $1,401 million in financial year 2016 and 17. There was a decline of $131 million from the record result of the financial year 15 to 16. The statutory profit before tax was $850 million in financial year 16 to 17, and it decreased approximately $176 million compared with financial year 15 and 16, because there was one-off benefit of the gain on sale of the Sydney domestic terminal. For the return on invested capital, it was 22.7% in financial year 15 to 16, and it decreased to 20.1% in financial year 16 to 17. Statutory earnings per share also suffered a drop of 3.4 cents in financial year 16 to 17. It was 49.4 cents in financial year 15 to 16, which can negatively impact investors' confidence. Net cash flow hit a new high of $28.19 million in financial year 15 to 16, but it decreased to $2,704 million in financial year 16 to 17.
In financial year 2016 to 17, profit of the year is 180 less than total comprehensive income of the year, while in financial year 2015 to 16, profit of the year is 179 million more than total comprehensive income in the same period. Apart from net profit, total comprehensive income also includes change in equity that are not realized. For instance, unrealized holding gain or loss from financial hedging instruments, securities, and foreign exchange rate. The difference between the profit or loss and total comprehensive income in the two fiscal years come from the following source. Firstly, defined benefit actuary loss or gains, net of tax, which was 175 million for financial year 2016 to 17, and negative 209 million for financial year 2015 to 16. This metric is hugely affected by discount rate used to calculate the present value of payments and expected return from assets. This is a recurring event. Secondly, hedges and hedges reserves, which added up to 18 million for financial year 2016 to 17 and negative 15 million for financial year 2015 to 16. This metric illustrates the gain or loss from financial hedging tools. This is a recurring event. Thirdly, foreign currency translations, which is negative 13 million for financial year 2016 to 17 and 26 million for financial year 2015 to 16. The positive sign of this metric mainly comes from currency depreciation of Australian dollar, while the negative sign of the metric can be attributed to currency appreciation of Australian dollar. From May 2015, Australian dollar started to depreciate, and this trend continued to May 2016. And then the value of Australian dollar continued to be low. This is an extraordinary event that will happen when there is a huge current appreciation or depreciation.
AASB 16 is effective for annual reporting periods beginning on or after 1st of January 2019. The group expects to adopt AASB 16 from 1st of July 2019. AASB 16 will replace AASB 117 leases interpretation for determining whether an arrangement contains a leases. Interpretation 115 operating leases, incentives, and interpretation 127 transactions involving the legal form of a lease. Currently, operating leases, primary aircraft, and property are not recognized on the balance sheet on the AASB 117. AASB 16 removes the distinction between operating leases and financial leases for leases and requires, where the group is a lessee, and the recognition for all leases on the balance sheet as a right-of-use asset and the associated lease liability. The group expected to apply AASB 16 retrospectively. The expected area of impact on the group upon adoption of a new leases standard are set out below. The first one is recognition of a right-of-use asset and a lease liability for operating leases of the consolidated balance sheet. The second one also is in the most cases. The lease liability and the right-of-use assets are initially recognized at the present value of future lease payments, discounted using the interest rate implicated in the lease where available, or if not available, the group's incremental borrowing rate. Retrospective application will result in a difference between the right-of-use asset and the lease liability recognized on transaction. The third one is recognition of depreciation and interest expenses instead of operating lease rental expenses in the consolidated income statement. The fourth one is the repayment of principal portion of lease payments will classified as financing activities in the consolidated cash flow statement. The interest portion will classified as operating activities. Under the existing standard, operating lease rental are disclosed as operating activities. The last one is the group's aircraft lease rental payments are predominantly as US dollars denominated. The group manages its exposure to foreign exchange rate fluctuations as a part of overall group treasury risk management policy. While the group's foreign currency cash flow risk for lease rental payments are unchanged, the adoption for AASB 16 will result in foreign currency denominated lease liabilities recognized on balance sheet revaluing in response to exchange rate fluctuations in US dollars and Australian dollars exchange.
We're gonna finish our presentation. Thanks for watching us. Have a nice day.